Good afternoon or good evening, everyone, from wherever you're joining us in the world today. Thanks for registering and coming on to today's webinar. We do weekly webinars and we focus on different areas of property investment. And a lot of our previous webinars are on our Joseph Mews video channel. So feel free to look at those. And what we wanted to do is the weekly webinars cover all different topics from investors investing in all different parts of the world. But we thought we'd put an extra one in today, looking at yesterday's budget here in the UK. As investors, yes, it's all about capital appreciation. It's all about rental yields. And a lot of people talk about gross figures, but we want to understand what the nets are. We want to understand what we're getting in our back pocket after costs and service charge. One key element, particularly after yesterday's budget, is looking at how we can get the most out of paying the minimum amount of tax as possible. So my name's Andrew Siegel. I'm managing director here at Joseph Mews Property Group. I don't think John is joining us today. He's over and he runs our Dubai operation. But I'm pleased to, I'll introduce you to Amy in a second. I've just got a couple of slides, but Amy's going to do all the heavy lifting, I'm pleased to say, because it's all about tax, all about the budget. She's from Flow Advisory, and we've been working with her a while, and we're happy to recommend her to our clients for tax advice. And we'll come on afterwards how to engage with her and how that works. If I could have the next slide, please. Thank you. So I can see we've got existing clients, new clients. So just allow me a couple of minutes just to give you a little bit of background, if I can. Just want to tell you a little bit about us. We were founded in sort of early 2000s by Andy Foote, who's the guy on the right there. He's our chairman. He started the business due to the fact that he was buying overseas. We're UK based, and he was buying in Spain, and it was a bit of a nightmare in terms of the customer care and the customer experience. This was 1999. He's still got that property. It's trebled in value, still going very well. But he thought surely we could make this when he started his own property business. We thought we could put the customer first and make it a better experience, whether you're based in the UK, whether you're a different part of the UK from where the developments are, or whether you're overseas. So we've got a global customer care department, and it's one point of phone call, and we look after all our clients wherever they're based in the world. We were a distribution partner, and I'll explain what that means in a minute, for some big developers in the UK. We've transitioned into Joseph Mews, and we work with arguably the best companies, the best developers in the UK, in the best locations in the UK, which give us, more importantly, you, our clients, access to the best stock and the best investments in the UK. If I could have the next slide, please. Thank you. We've been going a long time, as you can see. Well, not Amy, I'm old. We've been around the block a few times, been in the business for decades and decades. We're up to about 4,400 apartments sold, but more importantly, handed over and delivered. That's across 42, 43, maybe 44 developments now. And a lot of clients, up to 28% or more, are repeat purchases. So we help people build property portfolios. And we're over £500 million of GDV. What does that mean? £500 million worth of apartments, of developments have been delivered. So good track record. If I could have the next slide, please. Thanks. So these are kind of household names in the property development world. Elevate, we develop with them in Birmingham, and we joint venture with these developers. So we do the sales and marketing, which is pretty easy, to be fair. It's a strong market. But we do the handover and a lot of all the customer care for the developer. So our clients love us because we do everything. Developers love us because they can just get on and build, and we take care of the customer side of things. Elevate are an award-winning property developer. They're all very well funded. They've all got excellent track records. We have our own research person in-house, but we work with the JLLs, the Knight Frank and the Savills for a lot of research. So we look at the best areas to develop, the best developers to work with. So household names which really enable us to get the best products with the best developers in the best location out to our client database. If I could have the next slide, please. Okay, so there's quite a lot of moving parts, whether you're local, national, or international. We've got a UK office, we've got a Dubai office, we've got a South African office. We don't develop in those other countries. It's just to support clients that are investing back into the UK. So we'll get you a unit, we'll get you reserve, we'll get you to exchange on a particular property. We give you customer care, build updates if it's an off-plan investment. We get involved in the handovers. It's our own customer care team based in the UK. The girls, the ladies will do the handover. Lettings, mortgages, tax advice with trusted third parties like Amy, who are regulated to give the right advice, and after sales. Morally and contractually, we're in for the long haul. So 2 years down the road, there's a leaky tap. It's us on behalf of the developer that will get involved. So that customer care, born out of Andy's experience, which you mentioned earlier, is super important, and it's why we've done so well and why we've got a super track record. If I could have the next slide, please. As I mentioned, you can see probably bottom right of your screen there, there's a little Q&A box. I'll hand you over to Amy in a minute, who's going to cover everything in some detail. But please, anything tax related or anything property related in general, make the most of Amy while you've got her and myself, and we can answer anything that's property related. If I could have the next slide, please. Okay, fantastic. So I can relax, hand you over to Amy, who's going to tell you everything you need to know about yesterday's budget and what impact that'll have.
Thank you, Andrew.
Thanks.
It's a pleasure to be here, my second webinar of the day, talking about tax. I'll be talking about it in my sleep at this rate. So my name is Amy Richardson. I am the Director of Floex Advisory. I am a chartered accountant and a property tax expert, and my firm is fully niched into property. So essentially, our clients are only in the property space, whether that be an overseas investor, a UK investor, a portfolio landlord, or even developers themselves, and even right out to construction companies that are involved in property that way as well. So let's have a chat around the budget then. So I'm sure most of you tuned in and you saw that, firstly, the document was leaked. So if you're on your game, you already know all the answers and you knew them before 12:30. But essentially, yesterday's budget, it was a clear attack, not attack, but there was a clear message to say that the UK government is targeting people that are of higher wealth, already have property and have asset-based income. And then we saw slight reliefs for retail and high street businesses. So let's just go through what you need to know then. So there was no direct income tax rate raises. So basic rate bands, everything like that stayed the same. So in terms of employment income, you're still going to pay your 20, 40 or 45%. However, what the government did do is they remained, they froze the thresholds, so they're still frozen, and they will remain frozen until 2031. So that creates what we call fiscal drag, which we'll talk about a little bit more on the next slide. What we did see though, specifically in relation to property income, is there's going to be an extra 2% on that income from property if you hold property in your own name. And that goes across all bandings apart from additional rate. So rather than 20%, you'll pay 22%. Rather than 40%, you'll pay 42%. And then additional rate will stay as it was at 45%. We've also seen an increase in dividend tax and also saving tax rates as well. There's a mansion tax style surcharge coming into place in the realms of council tax, and that's going to come in from 2028. And then we had a little bit on business rates reforms as well. So this is good news for anyone in the small retail hospitality sector. Sorry, can't get my words out. but not so good for people in the larger commercial space. So, in effect, I think what we're trying to say is that I think everyone, in some way, shape, or form, will be affected by yesterday's budget. So let's just look at personal tax then. So what's actually changing here? I always like to present it visually so you can actually see the numbers. It's a little bit easier to digest. So at the moment in the UK, we have what we call a personal allowance. So the personal allowance of £12,570 is taxed at 0%. And effectively, what the government are saying is they are not going to increase that until 2031. And even then, they probably still won't increase it. And the higher rate is 50,270, additional rate 125, 140. So those allowances and those rates, they have not changed. But what happens over time is obviously we have inflation, the cost of living goes up. So we get what we call fiscal drag. And what will happen over time is that more people will get dragged into higher tax brackets. So by the end of 2031, you'll actually see a lot more people within the higher rate and additional rate tax bands, meaning that the government have been able to collect more money out of you without actually telling you directly they have raised a tax percentage point. They've actually just done it quietly through freezing the bandings. We had a little bit on pensions as well. So, in terms of salary sacrifice, there will only be no national insurance on the first £2,000. So, any contributions over that amount, they will attract national insurance. So, that will be both for the employer and the employee. So, we'll have national insurance on both of those. So, mainly the people that will be affected here are anyone within the higher rate or additional rate tax bandings. You're going to be hit with that. So a practical point here would be to review your salary, your dividend, your pension strategies for the next 5 years or so, just to see if there's anything that you can do, swap, change around to get the most out of that dynamic. The big news, property investors. I'm sure we have quite a lot of you on here that are in property. So a lot of this relates to people that have property in their personal name. So we already know if you have a personal property, an investment property that's owned personally, so not in a limited company or a trust or anything like that, just in your name, then at present you would pay 20% basic rate tax on those profits, 40% at higher rate, and 45% at additional rate. And now the government is saying, well, we want an extra 2% from you. And this actually makes the situation of owning properties personally a lot worse. And that's mainly due to the mortgage interest relief issues that are already there. So if we had mortgage interest of £1,000, if you owned the property in your personal name, the taxman will only let you have 20% of that as a tax relief. So actually by increasing these rates by 2 percentage points in each bracket, we'll see a higher overall blended tax rate for those that own property in their personal name. So therefore, looking forward, what we should be really looking at is a limited company structure. And obviously a more advanced version of that would be a holding company or a group structure. That those structures now become a lot more attractive because the base rate tax from a corporation tax perspective is going to be a lot lower for the majority of people in that situation. So moving on to the mansion tax, if you're lucky enough to have this problem, it will be coming in from April 2028. So it applies to owners, not occupiers. It's effectively an extra council tax. And the sticking point here for people really will be on the valuations, because obviously that is what they are going to be basing their tax charge on. So that's an area we expect HMRC to place a lot more scrutiny on. So if you are within that bracket, you need to make sure that you're getting proper valuations, and hopefully on the lower side of 2 million. So the main one here, and I say main one because this affects a lot of people in different ways. So whether you're in employment and you take dividends from other businesses, or whether you're a business owner and you're just taking a basic salary and the rest of your income through dividends, which is very common. What they've done here is they've actually moved the rates up. So previously you would pay 8.75% on dividends. So for a typical business owner, you usually pay 8.75% on dividends of around £37,700. And the reason for that figure is because 37,700 plus that 12,570 that we saw earlier, the personal allowance, that gives you a nice blended rounded figure of £50,000, and you'd pay only the 8.75% tax on it. Now this is going up to 10.75%. So everyone who is doing that basic strategy, which most business owners do, and they want to continue to take the same amount of income out, which these days we probably still need to do that, then you will have to suck up that rate, unfortunately. And the same goes for higher rate taxpayers as well. So currently you would pay 33.75% on dividends, and that is going up to 35.75%. But they have given it a little bit of leeway and left additional rate at 39.35%. So really what we need to look at here is, again, that mix of salary versus dividend versus pension. How can you blend that to your advantage and your goals and your needs? Obviously, everyone is going to have different needs across the board, but it's essential that you look at this with your advisor to come up with a plan that obviously works for you. Now, if you do run a business and you have the opportunity to use retained profits, you just need to look at how you're using those. So, for example, if you're just taking that money out for the sake of it, or because your accountant's told you that's the best amount to take out, you might want to rethink that strategy, particularly if you're not using the whole of that income. It may be wise to leave some of that within the business and therefore pay less dividend tax. And of course, out the back end of this, ISAs and other wrappers, they become more valuable because of the tax-free wrappers that they come in as well. And so we had a little bit on business rates as well. So like I said previously, this is good news for retail, hospitality. Effectively, they will have permanently lower business rates and more funding. But the bad news on the other side of it, so we're going to have high value commercial property, so warehouses, logistics, anything large, retail, they will effectively end up paying more tax, is effectively what we're saying. So what does this mean for you as an investor or a business owner? So really we have three themes here. So the tax is shifting more towards property and wealth, which we have seen over the last 3, 4, 5 years anyhow, but it is still, top of their agenda to attack people that have property or have investments. It's worth noting as well that the traditional extraction methods, so when we talk about salary and dividends out of a business, they are losing value. So it will force you to actually revisit that strategy and make sure that it's still working for you. And of course, group structures and proactive planning, this now gives us an opportunity to revisit that. So what can we do with the tools that we have and the legal structures that we have in order to put in place a tax efficient plan for you and your investments, and make sure that the structure is working for you and not against you. So I think with a lot of the things in the budget, a lot of things are behind the scenes. The devil is in the detail. There's quite a lot of things that are not on these slides, because otherwise I'd be giving you a bedtime story to read. But really, there's some questions I think you should be asking yourself, particularly after today's session. So If you do own any personally owned properties, is now the time to incorporate those properties? So, does it make sense from a financial and a commercial point of view to move that portfolio into a limited company structure, given that we know it's a fact you're going to end up paying more tax on that portfolio? You could possibly look at holdco, propco. So effectively that's group structure. We could see if that makes more sense for you. And of course, are your dividends still tax efficient after 2026? Because that raise in income tax rates on dividends and savings, that actually comes into play after April 2026. So we've only got about 5 or 6 months before that change actually comes into place. And then salary sacrifice pensions. If a lot of you are in PAYE jobs, then you'd need to look at that strategy as well. And also remembering the inheritance tax changes that came out a little while ago. They all go into play with that one. And the last point here, would it make sense to do a tax review audit before April? And the reason I've put that in there is because this is a really good time now to kind of take a look at your portfolio, take a look at your businesses, just your overall plan of where you're at and where you want to get to. And if we can make tax efficiencies, then now would be a really good time to do that. Obviously, a lot of these changes, they are being drip fed over a number of years. So some of them are coming into play April next year, some of them 2, 3 years down the line. But of course, if we can plan and be more proactive, then we're going to be in a better position going forward. So I just want to give you a bit of an insight of what I work on, my team work on with clients. So we can help you with group structure setup and reviews. So that's more for advanced investors, maybe overseas or multiple property portfolios, different strategies. We can also offer a tax review audit, so we can have a look at your current position. You'll get a 60-minute recording of a video call and report with that, so you'll have some actions out the back of that. We can help with the portfolio restructuring as well, also exit and succession planning, and of course anything to do with HMRC in terms of clearances, making sure when we are doing reorganisations that they are approved from HMRC too. I know we've got Q&A now, but I did just want to point out a couple of things that were in the budget yesterday, but they're not on these slides because were in the detail. So particularly if we've got landlords that are holding properties personally, there's a strategy called incorporation planning. It's been around for a few years now. But essentially what HMRC are now saying is that you will have to apply for this relief. Whereas previously you didn't have to apply, you would just form the partnership, wait X amount of years, tick all the box in theory, and then away you go. But they are changing that process, so you will have to apply for it. So what we're going to see is a lot more scrutiny from HMRC in terms of portfolio landlords and how they're operating and what structure they're operating in. If you do own properties within a limited company, HMRC have also confirmed that they are going to double their late filing penalties. So at present, it's £100 for a late filing fee. It's going to double to £200, and I think it goes up to £1,000 on the third one out off memory. So there's quite a lot of things in the detail, the back end of the budget that they didn't really talk about very loudly. But all these little things add up, and effectively over the next 4 to 5 years, that there are things that are going to come out that if you're not careful, it will end up being that you'll pay more tax.
That's great. Thanks, Amy. Did you have anything else, or should we go into the Q&As? I've got a couple of things I wanted to point out as well. Just wanted to say thanks. That was made an ordinary subject that we've all got to face very interesting. So thanks for that. Generally, I think the budget was pretty good. It's not ideal, but realistically, we're looking at an extra 2% in terms of what it's costing us. Was that right? As a big key takeaway?
Yes, if the properties are owned personally, yes, in theory. If you do the actual calculations, it is probably worse than that.
Yeah.
Just from a tax advisor perspective, because how the tax is actually calculated, because it's based on inflated profits, that 2% is probably more than 2%, if that makes
Okay.
sense.
Yeah. Yeah.
And that's why we're saying it's important for clients to actually look at their portfolio and see whether it's worth moving it, or, you know, just buying in a limited company from day one, because then they avoid that issue. They have control over the income that's within that property business then.
Cool. And if I'm setting up as a limited company, I read the other day something like even before the budget, 65% of people buying in the UK are buying in a limited company structure because it was more tax effective then. It's probably more tax effective now. And you're paying an extra, when you're taking dividends out, you're basically paying an extra 2% on the dividends. Is that right?
Yes, but actually, as a property investor, because you've put the money in to purchase the property in the first place, it creates what we call a director's loan account. So
Perfect.
actually, that money, the company owes you that money. So let's say you bought a property for £100,000, keep the numbers nice and simple, and you put down a 25% deposit. So you actually put £25,000 into the limited company. And then what you can actually do is extract that 25,000 back out completely tax free, because effectively
Brilliant.
it's just a loan that the company owes back to you as the investor. So we should really be looking at the whole picture here,
Perfect.
in terms of investors.
Brilliant. And there are other benefits, aren't there, with limited company structure in terms of inheritance tax planning, when you capital gains, when you sell the property, you're not selling the property, you're selling the company, so there's no stamp duty for the other person or whoever's coming in. So there's some nice, well, very particularly if you're succession planning and tax planning for the future, some other key benefits there as well.
Absolutely. So the main thing with the limited company structure is that it gives you a very good basis of flexibility and control. So if you have a clear plan with one property and you've got a particular exit plan on it, you could purposely just buy that in its own limited company. So if you already had an exit with a certain buyer, for example, and they were already in a corporate structure, if they then purchased the company rather than the asset, like you said, then that is more tax efficient. The same with inheritance tax. If you're already in a limited company structure, it's a lot easier then to plan for inheritance tax and form what we call a family investment company. Um,
Brilliant.
and that can really help on the IHT side of things for sure.
Fantastic. I'm a simple property guy, and obviously we've got taxes and we do different presentations when we talk about capital yield and capital appreciation, sorry, and rental yield. Since the 70s, property prices in the UK have doubled on average every 10, 11, 12 years. We've got all the latest reports we can share with you from the JLLs, the Savills, the Knight Frank. And in the key areas we're developing in, they're predicting 25% capital appreciation from now until the end of 2029. And we've got detailed cash flow summaries. So we're still, even with all this going on, we've got detailed cash flow summaries. So we can show with mortgage payments, with stamp duty, letting fees, whatever it is, setting up your limited company, running your limited company, you're still cash flow positive. So although like everything in life and everything in the world, we're getting more taxes. They're only taxing us because they know we're making a lot of money out of it. So it's a small percentage, and I'm sure it's not going to get better over the years, but the fundamentals are still good with property investment, and that's what I keep my eye on. Yes, you've got to look at the detail, and we've got partners like Amy that will really help, and everyone's situation is slightly different because if you're based overseas and you're not earning any money, then you've got your tax-free allowance. But that's where specialists like Amy come in and can really look at your own personal situation. So yeah, so thanks for that. Any questions, keep them coming. I've got a couple here. So Rasha, thanks for these. Got a few questions. Are we going to get the recording? Yes, we can pass you send you over the recording. Are your properties regulated by the FCA? No, you're regulated, aren't you, Amy?
Not by the FCA. because that's actually like mortgage brokers, insurance people, but we are regulated by the Institute of Chartered Accountants in England and Wales.
Brilliant. So we're not, as a developer, as a promoter, we're not regulated. But when you're putting down, if you're buying something off plan, you're putting 20% down potentially now, the balance on completion. Those funds, depending on the developer and the development, those funds are protected. And we'd always recommend, wherever you're based in the world, have an independent solicitor just to check everything out. We don't receive any monies apart from a small reservation fee. All monies go through to your solicitor. So everything, there's a lot of checks and balances. Another reason I think why the UK is the most invested country in the world for property is English law. It's very fair. It's known. It's great. There's no surprises. Um, Russia again. I don't understand the personal tax part. Is it tax on income?
Yes,
So yeah,
yes,
you're
it is.
taxed on basically the profit you're making after all your costs, basically for letting out your property. How about the taxes for small properties, students, studios? Unfortunately, I think I'm going to say everything gets taxed. Is that right?
Yes, the only other thing to point out there is you do have relief like rent a room relief, um, which is worth something, but that's completely different. Like you're living in the property, renting out a room. Other than that, there's a very small property income allowance of £1,000, but that wouldn't apply to anyone who's purchasing properties at this level at least.
Brilliant. Iris, good question here. Do the higher tax bands that apply to property income also apply for non-UK citizens living abroad that own rental property in the UK with a positive cash flow? And would this personal allowance apply to this?
That would depend on the individual and where they're operating and what the double taxation agreement is with the UK. But if that individual owns the property in a UK limited company, then quite simply they would just pay UK corporation tax on any profits.
With not all, but we have clients from all over the world, and with a lot of companies, sorry, a lot of countries, 150 odd or more. There's this double tax treaty, so you're only paying tax here. You won't be paying tax in your home country. But again, we can check that. But the bulk of our clients, investors, are in countries where there is that double tax treaty.
Yeah.
Ishvar, this is a good one. Due to get delivery of first UK property early 26, is it possible to switch to a limited company?
It depends how far you are down the road with purchasing the property, but as long as you can arrange finance and funding and get the limited company set up prior to exchange of contracts and things like that, then it shouldn't be an issue. Not from a tax perspective anyway. I don't know from like a Joseph Mews point of view, etc. But as long as you complete in the limited company, then that's okay.
Yeah, because I think if am I right in thinking if you've exchanged in your name but haven't completed, you can, you might have to pay a few pounds in legal fees, but you can, we've seen that happen. You can change your mind and put it into a limited company structure or vice versa. If
Yeah.
you've already completed on it, there might be issues and you might have to pay stamp duty. Is that right, Amy?
Yes, because you
Okay.
then have to transfer the property from personal into limited company. Whilst there wouldn't be any capital gains tax, there would definitely be a stamp duty bill.
Perfect. Okay. So again, depends where you are, and it can vary person to person. Yes, Nguyen, thanks for your question. Do you support customers to set up limited companies in the UK? Yeah, part of our role is to do everything with you or for you. So we've got trusted partners like Amy, companies we work with for furnishing packs, rental companies, solicitors, and yes, either through Amy or other third parties, depending on what you're doing. Yeah, anything you can think of that you need, we can help you, point you in the right direction, or do it for you. Bilal, nice question for Bilal. Tax scenario in case of properties held by offshore entity.
What are we actually asking there?
I'm guessing if you've got an offshore company, an offshore entity, do you have to pay tax? I think I know the answer to that, but I'm sure you do, don't you?
Yeah, I mean, in most cases, what we would suggest, and this is just a generic advice, if you have like an offshore company, you would still be better off having a UK company, but you would have the offshore company as the parent company, if that makes sense. So the UK company would own the property, but then that UK company is owned by an offshore entity. So you start getting into these slightly more complicated structures, but that's what we tend to find works best. But obviously, it depends on the client, where they're based, what they are actually doing, etc.
Yeah, everyone's slightly different, aren't they? Depending on where you're based, whether you're earning any money in the UK, your tax-free allowance, how many properties you've got, what you're looking to do short, mid, and long term. So we'll call up a little box in a minute. You can tick the box for either myself or one of the team to talk to you about our UK investments, and also for Amy if you want to have is it a sort of a short free consultation, an initial consultation, Amy?
That's correct, yeah.
Brilliant. So you can find out, fairly quickly whether it's worth proceeding. So is a limited company better? Again, I guess it depends on your scenario. So tick the box, and Amy can have a chat with you. Find out a little bit about your personal circumstances and make some recommendations. John, thanks for your question, John. What's the efficient way to transfer two properties from personal name to a limited company?
I love that question. Thank you. Um, well, based on what HMRC are now saying about the incorporation process, it would rule out that as an option. So there was no strict rules essentially on what constitutes a property business. However, the more properties you held personally, the more that HMRC would believe it's a business because the more properties you have, the more you're going to be busy doing that as a landlord. Whereas if you only have like two or three properties in your own name, HMRC would be very quick to say, well, actually, this is just an investment. So, incorporation relief, which is the most important relief, gets rid of the capital gains tax, that actually wouldn't apply in this situation. So, in terms of what you can actually do, we'd have to, in this scenario, look at the calculations, look at the potential gains, look at the potential stamp duty, look at the dynamic to see, well, if incorporation relief is out of the question, which it sounds like it would be in this case, is there anything we can do with a management company or potentially transferring one of the properties to a spouse that's a low rate taxpayer? So there are things that you can look at, but again, it's specific to the circumstances, but that there are things that if you do only have a couple of properties, it's not the end of the world. We can probably do something to alleviate some of that tax burden in your own name.
Brilliant. I've got another question from Wilfred. Thanks, Wilfred. As a director of my limited company, if I take a small salary from my company, i.e., under £12,000 per annum, would that create tax saving for my limited company?
Yes. So if you take a salary in a UK limited company, that is a taxable expense for corporation tax purposes. So you could take 12,570, you take it out, assuming you have no other earnings, you pay 0% tax on that personally. And in the company, that 12,570 would come off the company profits and therefore saving corporation tax at your marginal corporation tax rate, which at the moment would be anywhere between 19 and 25%.
Brilliant. Thanks for that. I think I got a last question from Rebecca. Thanks for all your questions. A long one. I don't know if I have a rental property already under limited company, purchased cash and already completed tax returns last year. And this, does it still make sense to continue buying future properties with these new changes, giving the rise in dividend taxes? So that's first question. So I guess, does it still make sense to buy? A yes, because property prices are doubling. They've always doubled, as I say. My
And
dad's
also, Andrew, from the perspective of most property investors don't ever take dividends out because they're actually still in a day job or they're building for long-term wealth. So they just constantly reinvest the profits. So the chances of an investor actually taking dividends out is quite slim. And even if they did want to, the first port of call should be the director's loan account, because that
perfect.
money can come out tax-free.
Great. And we've got a lot of We have a lot of clients that do just that. I don't know many clients that sell their portfolio. Maybe if they haven't got people to, inheritance or anything like that. Most people just hang on to them forever, really. So it's just, limited companies, important things like inheritance, tax planning, capital gains. And most people will pull money out and buy again. That's how you build your portfolio. Your property prices have doubled. As I say, we're looking at a 25% increase in key areas in the UK between now and the end of the decade. So you probably, if you need that money and you want to spend it, happy days. If not, reinvest. That's what most people do to build a property portfolio. That's what most of our clients certainly do.
Yeah, absolutely.
Brilliant. And I think you probably asked about what's the best way to extract it. Yeah, again, through loans or reinvesting, really. Again, depending on your own circumstances. If you want to, my dad's 93, got a big property portfolio. I said to my dad, if you want to cash it all in and go to Vegas and put it all on red, I'm happy with that. He's worked hard and he's still invested in property. So it depends on you. I'm hoping for my sake he won't be doing that unless he wins, of course, and we double the money. But no, again, everyone's, as I say, circumstances are different. And as I said earlier, there's a lot of moving parts, and it sounds like I'm not a big fan of admin, but it's a necessary evil. But do it. You've got specialist people that can help on the purchase side, such as ourselves, and Amy on the taxation side, which is, I think, as we've seen today, is very much an important element.
Yeah.
Lovely.
Also, what I was going to mention, just sprung to mind, talk about limited companies. Companies House recently put their fees up for the incorporation cost of a company, and they have confirmed that they will be doubling in the new year. So, if we do have anyone that is considering setting up a limited company, I would urge you to do this sooner rather than later because come next year, it's going to become more expensive to be able to even do that in the first place.
And I'd say if you come to us, we can help there with Amy or companies that can set up those limited structures. That's quite straightforward, but it's the tax advice that's important. Um, Iris, is your expertise within UK tax optimization, or do you or your office also give advice to overseas investors?
It's mainly UK taxation, but we do work with other consultants that operate with offshore clients as well.
Because wherever you're, as I say, with a lot of clients overseas, so wherever you're based in the world, you're paying tax in the UK anyway. So
Yeah.
it's all to do with UK taxes wherever you are. If there's the tax treaty, the money will go back to you and you're not paying tax on it again. So it's probably, yeah, yeah. But if it's more specialist stuff to do with your own situation in your own country, then you'd probably recommend having someone local in country that knows the local laws and rules and regulations, I guess. Yeah.
Yeah, absolutely.
Brilliant. And then, yeah, Rebecca did South African. So maybe your team can, yeah, we can, with mortgages, 90 odd percent of our clients, whether they're based in Australia, Malaysia, Hong Kong, do purchase with mortgages. We do have cash buyers. Most people prefer to leverage. We'd rather have four properties and leverage and borrow than one. But again, everyone's a little bit different. Some people don't like borrowing, and that's fine. So again, with Amy and the team we've got here, we can help and advise. So thanks for that, Amy. Thanks for all your questions and Amy's answers. Appreciate that. Have we got one more slide, Sanjana, that will? Here we go. So nice and simple here. What would be most helpful? Just tick the box there or fill in the little thing. Book a free tax consultation. If you want to speak to us on anything else, property, mortgages, tick the middle box. And if you're just exploring, just let us know. We'll keep you updated. And we've got an end of year webinar next week, and then we do them weekly. We're taking a bit of time off for Christmas, and then we run into weekly webinars again, starting from January. Thanks, Amy. Thanks, Anjana, for hosting. Thanks for all your questions. Thank you, Iris, for saying thank you. Appreciate that. And glad to help and look forward to seeing you all soon.
Thank you. Take care.
Take care. Bye bye. Bye bye.